If you're under your full retirement age and you're currently working, or even thinking about working while collecting Social Security, stop whatever you're doing right now. Seriously. Put your phone down, close the other 14 tabs you have open, and listen to me very carefully. You are currently standing on a financial landmine, and the federal government is just waiting for you to take one wrong step. You probably think your retirement is safe. You worked hard for 40 years, you paid into the system, and you believe the Social Security Administration has your back. That is the illusion of safety. The brutal reality is that the system is weaponized against the middle class, specifically against working seniors who are just trying to outpace inflation. Today, I am going to expose a systemic trap so vicious, so perfectly engineered by the federal government that it can drain your bank accounts, trigger massive IRS penalties, and cause your Medicare premiums to skyrocket. And all of this happens just because you made an extra couple of $100 a week. It sounds insane, right? This is not some tinfoil hat conspiracy theory. This is federal law. I am talking about the $22,320 rule. If you do not understand the exact mechanics of this rule, claiming Social Security early could be the most devastating financial mistake of your entire life. In this masterclass, I'm walking you through the anatomy of what I call a complete financial slaughter. I'm going to show you how one innocent mistake triggers a chain reaction between the Social Security Administration, the IRS, and Medicare. But more importantly, if you stay until the end, I'll give you the exact step-by-step master rescue plan. We're going to disarm this bomb before it ruins your golden years. So, let's get real. To understand how deadly this trap is, you need to see it in action. I want to introduce you to someone. Let's call her Elena. Elena is 64 years old, a total rock star who's worked her whole life. Like millions of Americans, she decided to claim her Social Security benefits early because, well, life is expensive. She knows she's taking a permanent reduction in her monthly check by claiming early, but she figures, hey, it's my money, I paid for it, I want it now. Her monthly benefit comes out to about $1,800. Not a king's ransom, but enough to keep the lights on and the fridge full, or so she thought. A few months into retirement, reality hits. Property taxes go up, groceries are through the roof, and Elena realizes $1,800 just isn't cutting it anymore. She's feeling the squeeze. So, she does what any hardworking American would do. She goes back to work. She takes on a part-time consulting gig. She's using her decades of expertise, feeling productive again. She's classified as an independent contractor, receiving a 1099-NEC. She's crushing it. By the end of the year, she nets $45,000. In her mind, she just hit a home run. In Elena's head, she just won the game. She's getting her Social Security checks every month, and she brought in an extra $45,000 to pad her savings. She thinks she has outsmarted inflation. But here's the part that will make your blood run cold. Elena was dead wrong. She didn't just earn extra money. She unknowingly kicked open the door to a regulatory slaughterhouse. She didn't consult a tax strategist. She didn't look up the SSA limits. She committed the ultimate financial sin in the eyes of the government. She tried to be productive. And the system? Oh, the system is about to make her pay in blood. You see, the government doesn't like it when you double dip before they say it's okay. Here is where the first domino falls, and it's called the Retirement Earnings Test. Enter Title 20 of the Code of Federal Regulations, Section 404.415. This is the rule that the government keeps in its back pocket to snatch back your hard-earned benefits. The rule states that if you are under your full retirement age, there is a strict speed limit on your earnings. That limit is exactly $22,320. Memorize that number. Put it on your fridge. Tattoo it on your arm if you have to. Because if you earn even 1 penny over that limit, the SSA enforces a draconian penalty. For every $2 you earn above that $22,000 line, the Social Security Administration takes $1 back from your benefits. Let's look at the brutal math of Elena's situation. She earned $45,000. That's $22,680 over the legal limit. The SSA doesn't just give her a slap on the wrist. Because she's that far over, they are going to withhold $11,340 from her benefits. But wait, it gets so much worse than a simple deduction. Let me tell you how they actually take it. Now, here's the most terrifying part of Elena's story, and honestly, this is where most people lose their cool. The Social Security Administration doesn't just send you a polite bill in the mail with a "please pay" sticker. They don't want you to write them a check. They want to make sure you never even see your own money. They completely freeze your monthly benefits. Think about that for a second. Suddenly, Elena goes to the ATM on the 3rd of the month, expecting her usual deposit, and her account balance is exactly zero. Her $1,800 lifeline has been cut, and the government isn't picking up the phone to apologize. It's going to stay gone for over 6 months until the SSA satisfies that $11,000 penalty. They don't care if she has a mortgage. They don't care if she needs to buy insulin or pay the electric bill. To them, she's just a line item on a spreadsheet that needs to be corrected. The first trap has snapped shut. But this is just the beginning of the nightmare. Because Elena's Social Security checks have stopped cold, she starts to panic. And who wouldn't? Her property tax bill is sitting on the counter, and she needs cash, fast. In a state of pure desperation, she does the one thing that turns a bad situation into a total catastrophe. She logs into her brokerage account and liquidates $50,000 from her traditional 401k. She thinks, "It's my savings. I'll just use this to bridge the gap until my Social Security starts again." This is the exact moment her localized problem turns into a multi-agency financial hemorrhage. By pulling that $50,000 from a pre-tax account, she just added a massive chunk of ordinary income to her tax return. Let's tally up the damage to her taxable profile. She has her consulting income, her 401k withdrawal, and her taxable Social Security from earlier in the year. Her modified adjusted gross income, what the pros call MAGI, just blasted past $95,000. Now, two horrific things are going to happen simultaneously, and Elena won't see either of them coming. First, the IRS dragnet catches her, and they are not known for their mercy. Because she had $1,099 consulting income and a massive 401k distribution, the IRS expects their cut immediately. They don't wait until April. She was legally required to make what's called quarterly estimated tax payments. Since she didn't do that, the IRS hits her with Form 221, the underpayment penalty. She now owes thousands of dollars in back taxes plus interest and penalties. She's literally paying the government for the privilege of being penalized by the government. But wait, because the silent killer is still lurking in the shadows, and its name is Medicare. Under Section 1839I of the Social Security Act, Medicare looks at your tax return from 2 years prior to determine your premiums. They have a special tool for people who earn too much money. It's called IRMAA, the Income-Related Monthly Adjustment Amount. It's basically a surcharge for being productive. By spiking her income to $95,000 at age 64, Elena just guaranteed that when she turns 66, Medicare is going to slap her with a massive monthly surcharge. And guess how that IRMAA penalty is collected? It's automatically deducted from your Social Security check. Do you see the sheer cold-blooded evil of this chain reaction? Elena worked hard to get ahead. Because she worked, the SSA took away her benefits. Because they took her benefits, she panicked and pulled from her 401k. Because she pulled from her 401k, the IRS penalized her and Medicare permanently shrunk her future checks. She has been taxed, penalized, and squeezed by 3 different federal agencies for the exact same $45,000 she earned. She's not just back to square one. She's actually deeper in the hole than if she had stayed home and done absolutely nothing. It's a productivity tax that most people don't even know exists until they get the letter in the mail. And by then, it's usually too late to fix it. But I didn't bring you here today just to scare you. I brought you here to give you the weapon to fight back. Now take a deep breath. I know that was a lot of heavy news to digest. But if you or someone you love is currently stepping into this trap, there is a way out. You just have to execute this rescue plan with surgical precision, because in this game, the sequence of your actions is everything. If you do step 2 before step 1, you're finished. You have to follow the playbook. So, grab a pen, grab a napkin, whatever you need to take notes. Let's talk about step 1, killing the phantom income. This is where we get aggressive. Here's a secret the Social Security Administration doesn't exactly broadcast on their homepage. They only count your net earnings from self-employment. They don't care about your gross revenue. If you're a 1099 contractor like Elena, you have a massive legal weapon at your disposal. It's called IRS Schedule C. You need to sit down with a CPA who actually has a spine and utilize every legal deduction in the book. I'm talking about Section 179 deductions, home office setups, and mileage. If you bought a new truck or high-end computer for your consulting gig, you can often write off the entire cost in year 1. By aggressively deducting your business expenses, you can lower your net income on paper. If Elena can legally write down her net business income below $22,320, the entire SSA penalty vanishes. It just evaporates like it was never even there. The government can't penalize you for money you technically spent to run your business. That's the first way to disarm the bomb. But what if you've already messed up? What if you already claimed your benefits and realized you're in over your head? Well, it's time for step 2. This is what I call the emergency reset button. If you claimed Social Security early and realized you made a massive mistake, you might think you're stuck for life. But if you are still within 12 months of your claim date, you can file Form SSA-521. This form is literally an undo button for your retirement. It's officially called the Request for Withdrawal of Application. You basically tell the government, hey, I changed my mind. Take your money back. You have to pay back the benefits you've already received, but your entire record is wiped clean. It's like the last year never happened. Your benefits reset. They continue to grow by 8% a year, and you can claim them later when you're actually ready. It is the ultimate financial get-out-of-jail-free card, but you only have that 12-month window to play it. Now, what if you're past the 12-month mark? Don't panic. If you've already reached your full retirement age but haven't hit age 70 yet, you can voluntarily suspend your benefits. This stops the checks, but it also stops the penalties and lets your future checks grow larger. Finally, we have to deal with the silent killer we talked about earlier, Medicare and the IRMAA surcharge. Most people think once Medicare decides your premium, it's set in stone. They are wrong. You have a shield, and it's called Form SSA-521. This is the life-changing event form. If your income spiked because you were working, but then you retired or your hours were cut, or you lost a job, you can force the government to stop looking at your rich tax return from 2 years ago. By filing this specific form, you tell Medicare, my life is different now. I don't make that money anymore. This forces them to use your current lower income to calculate your premiums. This one form alone can save you thousands of dollars in unfair Medicare surcharges over the next few years. Do you see what we're doing here? We're not breaking the law. We're using the law to protect ourselves from the law. It's about being a chess player while everyone else is playing checkers. But there's one last thing I need to tell you, and it's the most important realization of all. It's about why this system exists in the first place. Because once you understand the why, you'll never let them catch you off guard again. We're going into the final stretch now, and this is the part they definitely don't want you to hear. Let's be brutally honest about what we just unpacked today. After looking at Elena's story and the triple threat of the SSA, the IRS, and Medicare, you might be thinking, how is this system so broken? But here's the cold, hard truth that most people aren't ready to hear. the system isn't broken at all. In fact, it is functioning exactly as it was designed. The bureaucratic maze of federal regulations isn't a mistake. It's a feature. It is built to catch the uninformed and the unprepared. They don't teach this in high school. And let's be real, most financial advisors won't warn you until the damage is already done. Why? Because the system fundamentally relies on your mistakes. It relies on your penalties, your extra taxes, and your forfeited benefits to help fund its own massive deficits. To the people in Washington, middle-class Americans who try to work hard and save for their future are just collateral damage. It's a sucker punch to the people who actually built this country. But here is the good news. Once you see the trap, you can walk right around it. Knowledge is the ultimate leverage, and today, you just gained a massive advantage over the average taxpayer. By understanding that $22,320 limit, you've already won half the battle. By knowing about the IRMAA trap and the SSA-44 shield, you're playing at a professional level. You are building a financial fortress around your wealth, one that the federal government cannot easily breach. But don't stop here. The rules change, the limits get adjusted, and the government is always looking for new ways to move the goalposts. That's why you need to stay vigilant and keep your head on a swivel as you approach your golden years. If this masterclass opened your eyes today, you have a responsibility. Do not let your friends, your family, or your former colleagues walk blindly into this regulatory slaughterhouse. They deserve to know what's coming for them before it's too late to fix it. Share this video with anyone you know who is approaching 62 or thinking about early retirement. Hit the like button so the YouTube algorithm pushes this warning to the people who need it most. And if you want to keep arming yourself with the financial and legal truths they don't want you to know, hit that subscribe button. We're building a community here of people who refuse to be victims of a complex system. We're taking back control of our retirement, one form at a time. Check out the links in the description for more resources, and keep an eye out for our next deep dive into the IRS hidden rules. Thank you for sticking with me through this breakdown. Remember, it's your money, you earned it, and you deserve to keep every single penny of it. Stay vigilant, stay informed, and I'll see you in the next one.